Hi guys, how's it going? It's a lot. I'm checking and coming to my YouTube channel. In today's video, we're going to look at the best high growth ETFs. These are the ETFs that have returned more than 20% in the past year and more than 10% in the past 3 years, 5 years, and even 10 years. And also, these are well-diversified ETFs that have majority of their holdings in tech, and we all know how fast-growing tech is. And growth ETFs are actually designed to invest in a basket of stocks that have the potential for rapid growth as opposed to being overvalued. So if you look at the top 10 holdings of these ETFs, you will find that most of those companies are actually the best large companies in the world. The S&P 500, you find that in the top 10 we have companies like your Amazon, Nvidia, Tesla, Alphabet, Meta, and Microsoft. And these are some of the largest companies in the world. And the advantages of growth ETFs is that they give great returns. Remember, if you want dividends, you cannot look at growth. And if you want growth as well, you cannot focus on dividends. And if you're still unsure on what the difference is between growth investing and dividend investing, I made a video the week before last, so please go and check it out so you can have a better understanding of what we mean when we say dividend investing focused and growth investing focused. And please remember that none of my videos constitute as financial advice. I am not a financial advisor. And number one on the list, we have the Nasdaq 100 ETF. This ETF includes companies listed in the US stock market and that are operating across all sectors except for financial sector. And it is heavily weighted towards technology companies. So it is made up of 100 largest companies in the US, excluding companies in the financial sector. So if you want more technology exposure and growth, you can consider investing in this ETF. If we are going to factor in diversification, then it is diversified, but not too diversified as it only has 100 largest companies. And those companies are mostly in tech. So it is a high risk ETF, but it has good returns. Remember, high risk, high return. The performance in the past year, it has returned 27%. 13% in 3 years and 5% in 5 years. And the second on the list is the S&P 500 ETF. Now, this ETF tracks 500 largest companies in the US stock market by market cap, and it is generally used as a benchmark to determine how the US stock market is doing. And in a year, it has returned 29%. 14% in 3 years and 19% in 5 years. And if we are going to compare the Nasdaq 100 and the S&P, the Nasdaq has outperformed the S&P from 2008 to 2023, posting a total average return of 17% and only 9% for the S&P. But then, Nasdaq is a high risk as compared to the S&P. Remember that Nasdaq only tracks 100 companies and most which are in tech, while the S&P exposes you to 500 largest companies in the US stock market. So because it has so much risk, that is why it will outperform the S&P. But then, the S&P is recommended over the Nasdaq, even though Nasdaq outperforms it because it is less risky, therefore making it a safer option. So if there was to be a technology crash, the Nasdaq will take many years to recover or more time to recover than the S&P would. And there was a crash called the dot-com crash in the late 90s, and Nasdaq took a good 15 years to recover, while the S&P only took 7 years to recover. And it's all because the S&P is well diversified. It has so many companies operating in other sectors that are not tech. And Nasdaq is heavily weighted in tech, and this was the tech crash. So obviously Nasdaq was going to take more beating than the S&P. And in terms of recovery, obviously the S&P is going to recover very quickly because it has all other companies in different sectors carrying the index. So with Nasdaq, you are actually betting on technology. That's where it differs with the S&P. And guys, like I have said, with growth investing, you focus more on growth, not dividends. But then there are growth ETFs that are paying dividends, but then the dividend yield is less than 3%, and understandably so because they are growth ETFs. And I know that the Citrix S&P 500 does not pay dividends and the Signia one pays dividends, even though the dividend yield is 1%. So if you want growth and a bit of dividends, even though they're going to be peanuts, then you can opt to invest in the Signia one, not the Citrix one. Again, even though the Signia one pays dividends, the performance between the Citrix one and the Signia one will still be the same, because the dividend yield is low for the Signia one and they are tracking the same companies. So you don't have to worry about the performance as to whether maybe the Signia one will perform less as compared to the Citrix one. It's going to be the same. And the third ETF is the MSCI World ETF. This ETF tracks stocks from 23 countries. These are large and mid-cap stocks in developed countries and stable economies. And this ETF is heavily allocated into the US stock market at 68% and 6% in Japan, 4.2% in the United Kingdom, and 3.3% in Canada, and then the rest follows. And it has returned 23% in 1 year, 16% in 5 years, and 15% in 10 years. And then we have the MSCI US ETF, which represents 600 largest companies in the United States stock market. It has returned 29% in the past year, and 19% in the past 5 years, and 17% in the past 10 years. And this one is a bit more diversified as compared to the S&P 500 because it has 600 companies and the S&P has 500 companies. The performance is not far from each other because the S&P also returned 29% in the past year and 19% in the past 5 years. They are most definitely overlapping by a huge percentage because they have the same companies in their top 10 holdings. So buying this ETF is the same as buying the S&P because they are overlapping. So having the both of them in one portfolio is a duplication. And remember, I say one portfolio. And the problem with ETFs, especially if you don't do your research, is that you will end up having multiple ETFs that are tracking the same companies. They are going to perform the same way. So you don't want to have duplications because you incur investment cost and not forgetting the expense ratios. So why not just buy one ETF and just incur one cost in one ETF? So you really have to balance your portfolio by making sure that they do not overlap. Then there is the FANG ETF. This is your technology ETF. If you want exposure in AI, then this ETF is for you. It has returned 41% in the past year and it beat the S&P in the past year. And it was launched recently in 2023, so I cannot see the performance for the past 5 years and even 10 years. But then we know how fast growing technology is in this day and age. So hopefully it's going to continue to perform well for as long as technology is moving the way it's moving right now. On number 6, we have the Global 1.2 ETF. It tracks more than 1,000 companies across the world in 30 countries. It has returned 22% in the past year and 16% in the past 5 years. Adding growth ETFs in your portfolio is actually good for it because you're going to make more money and your returns actually are going to look great. Now, if we are going to compare it with dividends, if you have this ETF that returns you 40% in 1 year, you have actually beaten some of the dividends ETFs or stocks for time if that ETF has a dividend yield of 10%. So in a nutshell, growth investing beats dividend investing. But then go do further research on these ETFs and then you will decide which one you're going to add to your portfolio if you don't have it already. And that's it on today's video. Thank you so much for watching. I will see you next week. Bye.